We're at a time when the global economy is struggling with the coronavirus pandemic, trying to figure out the new landscape. GDPs are at worrying lows, millions have lost their jobs, and investors are trying to find bright spots. And a new wave of the coronavirus pandemic is here. Just this week, Melbourne issued shutdown to try to curb the virus. And a company called bannerassetmanagement knows the impact that this coronavirus has had on the real estate sector there. So let's first broaden out. How are investors assessing risk right now?
We've seen a slight change in investor attitudes, but no major change, I wouldn't think. There's been a greater emphasis on risk and return by investors, and with focus on risk, with a slight, probably accepting less risky products to slightly lower returns. We've tried to meet that challenge through providing a broader range of product to our investors, and one of those products involves a lower value LTV that is loan to value ratio. So in other words, the amount that we lend on the property, on the value of the property, is the LTV, and our exposure is limited to around 65% on an average loan. We are now looking at offering loans with 50% LTV. This leads to a lower rate of return, of course, but still impressive at around 7% for that product. There is certainly an increased attention from our investors on the asset itself. A lot of our loans are asset specific, and the investors get to see the asset they're investing in. So as we are, investors are looking more closely at the fundamentals of the investment to ensure their security and maintaining a decent return.
And how has COVID-19 impacted the business overall?
I think in the early days when we were rushing around when this commenced, we viewed the most important thing was to get our internal communications right so that we could work to preserve the assets that we had under management. So we're probably a business that has a lot of travel involved and so on, so we're quite accustomed to remote communications. So we ensured everyone was set up for that and placed a great emphasis on communication. So the communication has to be between the members of the team, but also communication with our investors to know that we're there, we're active, and we're looking after the assets. Once we had that established, it was really a matter of preserving the asset, and that involved us interacting closely with all of our developers and counterparties involved in any project that we had. We were focused on elements such as construction projects continuing at the agreed pace. That includes supply chains being uninterrupted, everybody being on site, COVID practices being observed, so sites couldn't be shut down. So there was an analysis of every one of our transactions. This was all within a few days of shutdown. So we knew pretty well where we stood on each project within a few days. That, of course, was communicated to investors who are naturally anxious about the effects on the projects. On the fund side, we took a conservative approach. We have many liquidity events in our management of projects, so we took the decision to go quite long in cash on all of our pooled funds, and I think we got up to levels of over 20% on some of the funds, and that's a highly conservative position. But our view was we would experience a cash drag, have some slightly lower returns, and wait and see how the pandemic developed. That worked very well. I think we didn't see a rush from investors. We didn't see any panic from our investors. They were very solid. And indeed, I think in recent times we've seen inflows much greater than outflows. So that's been a very pleasing result.
So let's drill in a little bit into Banner's approach, actually. So you started out with a smaller pool of investors, and was it your intention to grow organically?
Yes, it's a short answer. We didn't go out, we didn't go raising large pools or to kickstart us off. We didn't have a large cornerstone investor, and we never wanted one. So we adopted a project-by-project strategy when we initially started, which is also supported by a small amount of pooled funds. The friends and family investors, you should call it, but the circle kept widening. And having come from the capital markets industry where I worked most of my life, we had a huge audience. So we had a lot of people who could talk to about the opportunity. Certain individuals didn't like it. There was a lot of introductions made to other funds, other individuals. So we had a good circle. The original shareholders, who are still the same shareholders, spread the word. And between us, we raised the funds as and when we needed them. Our financial investment really was into the team who had the property, the legal, the fund management expertise. And that's grown from 3 to 30 today. The majority, obviously, of our investors are high net worths, but we have also other lenders, and it's grown now. We have overseas banks, family offices, funds. We were fortunate, secured quite a lot of investment from these people, and it's been good. So there was no actual marketing plan. We just marketed the product. So secondary lending in market in Australia at the time was really sort of lawyer-based trust funds, and we're seeing that change over the last 15 years into a well-regulated, well-licensed and disciplined group of funders. Some of the early growth really was just due to timing. As we opened up, there's a lack of private capital in the market and a great reduction in bank lending. So some of the returns we were getting in the earlier days was really a risk-return dislocation. As the banks had their problems with the GFC, Basel III, capital adequacy ratios, etc., and retracted their capacity for lending, it opened up a great big void for private money. So timing was great. And such growth led to a lot of close and sort of personal identification with our investors. And actually that continues. Most of all the original investors are still with us. And the investor first ethic is what pervades through the business. Most principals and all shareholders invested in all the funds. Many staff invest too. So I think the organic growth has been reflected in the investment offering, from vanilla secured lending now to secured income products at various levels of risk, with the specialist opportunity funds, pooled funds and single asset lending to direct property, which products will expand to the investors' demands.
Talk to us about the due diligence process.
Yes, well, beyond the financial analysis undertaken on every transaction, our due diligence includes, probably starts with the property. What is its location? What is the demand within that location? What we're looking at is a property that can be sold, and we can be confident that the property or the end project can be sold. So we will look at any competing product in the area, the price point of the product that we're looking at, what are the proven up demand through pre-sales, and the quality of the product to ensure that it maintains the market throughout. If we're satisfied with the property as a security, we will then look to the borrower and his team. So we would be looking at the history of the borrower, his financial status, his credit history. Does he have experience in projects similar to this? And when I say similar, he's done almost the same projects year after year. This is not a major change in any way from what they've done before. And we will take that analysis down to the developer's project partners, so the builder, the project manager, if there is one, the QS, the planning consultants, and so on, to ensure that there's a strong and cohesive team in there that can deliver the project on budget and on time. Banner, a little bit unusually, I think, specialises on the east coast of Australia. All of our lending is located there. And the reason for that is depth of market. We need to, I suppose, about 80% of people of the Australian population live on the east coast. So it's the area with most industry, most demand, and most population growth. So we lend up and down the east coast of Australia only. Finally, I suppose we look at macroeconomic factors. We don't really make predictions, but we look at what's going on with population growth, rates, general economic conditions, and demands within sectors. We receive advice on that. We receive valuation reports and adjust our lending according to those factors.
So many of Banner's investors are foreign. Do you see any particular challenges for offshore investors when it comes to the Australian market?
It's not an area where we've had any real difficulties with foreign investors and their appetite for Australian product. There's a few hurdles, typical questions we get from investors. Foreign Investment Review Board decisions. We have a National Foreign Investment Review Board, but fortunately property debt investment is not covered by the Foreign Investment Review Board, unlike a direct property investment. So that is not an issue for investing in our fund. Funds or overseas institutions or funds that are investing a lot in Australia and being very active in their management of assets within Australia could face regulatory hurdles with needing to register under the Corporations Act. But that's where investing in a fund makes that a lot easier, as they are merely investors. They're not active participants running a business within the country. So provided they're investing in a fund, there shouldn't be any registration issues. Probably close to the investor's heart would be tax. Where we are a debt fund, the returns that we pay are in the nature of interest. And with any country that we have a double tax treaty, which is all the countries that we have investors located in, has a 10% withholding tax, which is deducted by the funds manager here in Australia, paid to the tax office, and then statements given to the borrower. That would become a tax credit for the borrower in their local jurisdiction. I suppose looking at the tax issue, the borrower is weighing up the returns, which are typically 10, 12, 13%, in making their decision as to whether to invest. Security, I think we have a very open and understandable security and legal system in Australia. All of our securities are registered. They're unimpeachable. And fairly simply taken. So security is quite good. Also, the recovery process, if we ever get in that situation, is fairly standardised and formulaic. We know what steps to take, and we can take them very swiftly. Probably for most jurisdictions, we can take them extremely swiftly. Often within days, we can take possession of a property in the rare cases that we need to. Probably the other major issue for overseas investors would be we are denominated Australian dollar fund. So there is exchange rate risk with that. We don't manage that risk for investors. They manage it themselves if they see that as an issue and choose to manage it. So they're probably the major issues that investors have when looking at our funds.
Okay, well, Australia is a very property-focused economy. So how detrimental is a downturn in prices in the months and the years ahead?
I think residential markets in Australia have proven over decades to be very resilient. We haven't seen any major changes. We've had a couple of short, sharp shocks, such as GFC and the recent pandemic. But historically, property has bounced back very quickly from those shocks and has a gradual appreciation trend. When we're looking at lending, we're not lending on sort of speculative product. The product before we get involved has been proven up as having demand, and that will be done through existing pre-sales of product, so that we know that there is an exit there through the settlement of those sales. Sale contracts in Australia are full recourse, so any borrower signing up for the contract is not only putting down 10%, but is also liable to pay the balance and at risk if the balance isn't paid. After the first lockdown, we did have a somewhat of a rebound in prices. The market returned to normal, which was pleasing to see. And of course, the second lockdown may have a further impact, but we'll wait and see, and we'll just act prudently until that occurs. Our role is not really to predict the future of property in Australia. We deal with known parameters at the time, and adjust our risk weighting on our investment according to those parameters.
Okay, so what are some big projects and highlights ahead for Banner Asset Management?
I was going to say we've just finished a massive shopping centre, which is it's not up there yet, but it's part of $1 billion project. It's been huge. We've been involved in that for about 3 years. We've done some major land subdivisions. So there's been some changing of the landscape in some of the projects that we've actually funded. It's been quite exciting. Sorry, Brett.
I think highlights coming up will include new funds. We're slow to open funds, but we have a number in place. We're looking at a more conservative fund for property-based investment. That's the low LTV type approach that I'm talking about, but pooled funds in that area, which we think we'll see quite strong demand as returns are fairly attractive for that fund. We're also seeing a lot of opportunities in general lending and equity space, and it seems at the moment that there is a consistent demand for our product from borrowers, and sort of a lack of funding within the market due to various circumstances.
Andrew, can you tell us what you're telling investors? What should they be looking at going forward?
Going forward, we're still offering existing a new product based on investor demand, and what we tell them is that ultimately the product still remains a secured income return at superior rates to usual income products. So ultimately, it's about the fundamentals of real estate. The strong fundamentals that drive residential markets in the cities, the suburbs, and regional areas, we feel will still prevail. We'll come through this, and those fundamentals will still hold up. The low interest rate environment at the moment, with the federal government's willingness to provide stimulus to the sector and the wider economy, should provide some degree of confidence and security in the long-term reliability of the housing markets. And I don't think we should all overreact to the short-term perceptions. It's going to be tough, and we know that there's a bit of a rocky road coming up, but we'll get through. I think the fundamentals are still there.
Thank you for joining us.
Okay, thank you.